Hey everyone, welcome back. I am absolutely thrilled to have you here today. In this explainer, we're unpacking a massive, honestly kind of unexpected financial maneuver right in the middle of this AI boom. We're looking at Intel, the legacy titan of the silicon world, and their sudden towering stock offering. If you want to understand the hidden financial mechanics behind the AI revolution, like how the actual pipes and foundries of tomorrow are being paid for today, you are absolutely in the right place.
Section 1. The Tech Funding Divide. Okay, let's dive into this, because there is this fascinating mystery unspooling right now about how massive tech companies are actually funding these grand AI ambitions. It turns out they aren't all playing by the same financial playbook. Like in the broader big tech landscape, companies like Meta, Oracle, Alphabet, they've largely borrowed their way through the boom, right? Meta sold roughly $30 billion in bonds last fall, and Oracle is constantly tapping the debt market. But Intel, they're doing the exact opposite. No bonds, they're issuing equity and stock. It's a stark contrast in strategy for sure.
And we aren't just talking about a little bit of stock here. Intel launched a staggering $15 billion stock offering. $15 billion! And honestly, that number could climb even higher, maybe a little over $17 billion, if underwriters take their full option. To put that into perspective, that is just an enormous amount of equity to drop onto the public market all at once.
Section 2. Intel's massive AI bill.
So, why does Intel need all of this cash, like yesterday? Well, it basically comes down to the sheer physical infrastructure of the AI boom. They need to rapidly expand their foundry and advanced packaging capacity, because right now, demand is simply crushing supply. On their July earnings call, Intel's CFO guided that capital spending will top $20 billion this year alone. That's up sharply from initial projections, and they're signaling even more spending is coming in 2027. The financial mountain they have to climb here is just incredibly steep.
And this brilliantly illustrates how they've been handling it up to now. Over the past year, Intel kind of pieced together funding for this build-out by selling off little pieces of the company to strategic partners. The U.S. government came in at $20.40 a share, SoftBank at $23 flat, and NVIDIA at $23.28. Basically, they were finding specific partners to write very specific checks.
But this current offering? This is a fundamental shift. This time around, there's no single strategic partner sitting in a boardroom writing a check. Intel is completely bypassing those private deals and going straight to public shareholders to raise that $15 to $17 billion.
Section 3. Why stock instead of debt? Which brings us to a really logical question, right? If debt is often a way cheaper way to raise capital, which is exactly why Alphabet and Meta use it, why wouldn't Intel just borrow the money? Well, it all boils down to their investment-grade status. As you probably know, maintaining that credit rating is the golden ticket that allows a company to borrow at favorable rates. But right now, Intel's rating is hovering precariously near the absolute bottom of that investment-grade tier. They're literally living on the edge.
So taking on debt right now is just a really dangerous game for them, for three main reasons. First, Intel currently has negative free cash flow. Second, a massive new pile of debt would seriously threaten that already super fragile credit rating we just talked about. And third, because their rating is already lower than rivals like Alphabet, borrowing that money would actually cost Intel significantly more in spreads.
Which leads us to their strategic solution: equity. Selling stock basically solves the problem. It fundamentally protects Intel's credit rating because it doesn't add to their debt burden. So they keep that crucial investment-grade status totally safe, while still getting that immense amount of cash they need for the manufacturing build-out.
Section 4. The timing mystery.
Now, what's really interesting about this is the timing. Why do this right now? I mean, in the normal rhythm of business, you want your stock price to be as high as humanly possible before you ask the public for $15 billion, right? Ideally, you'd announce these massive foundry deals with flagship customers first, let all that good news pump up your stock, and then issue the new shares. But Intel didn't do that. Those flagship deals just haven't arrived yet.
Mizuho analyst Jordan Klein actually has a fascinating theory on this. His guess is that Intel simply couldn't afford to wait. The sheer urgency of AI demand meant they needed capital to start expanding right this very second. Paradoxically, it's like they might have actually needed to prove they already have the cash and are actively building the capacity just to get those customer supply agreements finalized in the first place.
And because they went out to the market without those big customer announcements to pad the blow, well, the immediate market reaction was pretty harsh. Shares initially dropped about 5% on the news of the equity raise before scaling back just a bit to a 3.5% loss. It is definitely a tough pill for current shareholders to swallow in the short term.
Section 5. The true costs of AI. Let's move to the broader picture here and see how this builds our understanding of the whole tech landscape today. Stepping back from Intel for a second, the ultimate takeaway is that their move is a blaring warning signal. The AI boom has just completely outgrown what even these massive tech companies can self-fund. Building the future of artificial intelligence is so staggeringly expensive that money has to increasingly be pulled from the broader debt and equity markets. The era of tech giants easily bankrolling their next huge leaps entirely out of pocket, yeah, that might be pausing for a while.
Which leaves us with this final, incredibly important question. If the richest tech giants on the planet can no longer independently self-fund the AI arms race, and they have to repeatedly tap into public markets for tens of billions of dollars, who is ultimately going to foot the bill for all of this in the long run? It's a massively shifting financial landscape, and the stakes have absolutely never been higher. Thanks so much for joining me for this explainer. Keep asking those big questions, and I'll catch you next time.